Hi everyone, my name's Mark and you're watching Resource Talks. I'm pleased to be joined today by an ETF manager whose fund tracks physical metals needed in electric vehicles, batteries and solar energy. So we're going to be talking about the outlook for those metals, lithium, nickel, copper and cobalt. What we're not going to be doing, though, is giving financial advice. So please read the disclaimer on your screen and remember that you and you alone are responsible for taking care of your capital. With all that said, Will, thanks for investing your time with me.
Yeah, happy to share it with you.
Could you start by telling us about who you are and how you got involved with the fund?
Sure. I've been up and down Wall Street, as they say, working in Manhattan since about 2007. Prior to that, I worked in professional sports and had a fun career there. In 2007, I started a debt and credit fund of funds at Avenue Capital, which is a $20 billion private equity shop at the time, investing in debt through that, downturn, as they call it. And then in 2010, I was recruited to Goldman Sachs, where I was lucky to manage the private capital of the partners at Goldman and focus on how they allocated their private wealth, which leads us somewhat to where I am today, because a Goldman partner is really focused on liquidity. The majority of their net worth is tied up in Goldman stocks. So our desk would constantly be trying to find emerging asset classes, but also liquid ways for them to participate. So I did that for several years, and then I left and formed a SPAC in 2013. Before people knew how to spell that. We were $825 million of $1.2 billion worth of SPACs done. In 2014, we listed on the London Stock Exchange. I did that with the former CEO of Barclays, Bob Diamond, and we bought banks throughout Africa. Since that time, I've been running my own family office and investing. Since about 2018, I've been investing in mines and quarries. I have a very big stake in the granite operations of North America through my now partner, John Raymond. He and I co-invested in that and have bought various assets throughout mostly the United States. John Raymond and John Calvert are my co-founders of this venture. They run Energy Mineral Group, private equity shop, which is a $13 billion private equity shop in Houston that owns assets globally throughout the entire energy complex. And actually, John Raymond approached me because of some relationships in the White House. And he said, we need to really talk to the government about the fact that all of these elements necessary for battery futures, or for our future, dependence on batteries for solar and wind and EV and any intermittent source and supply, really requires these core base metals that at the end of the day, China controls the supply chain of. And unless the US government does something proactive about that, we are completely at the whims of the Chinese government, and our capacities to deliver on these carbon neutral goals, net neutral goals, whatever you want to call them, are dependent on the Chinese government deciding that that's going to happen or not. And that's a scary premise, and that they just outmaneuvered us to date. So how do we go and work with the government to put together programs that will stimulate, US investment or friendly, democracies investing in the supply chains of these metals, so that our green future, could be a little bit more secure? And so we went through those conversations, which were fascinating to be a fly on the wall of. I'd hate to suggest that I was the loudest voice in that room. There were some very smart people talking, including John Raymond, of course. And, left those meetings and called my old desk at Goldman and said, how do I get long lithium and nickel and cobalt and copper? How do I buy or put my own money in the market to be exposed to this upside? And they said, you can't. They said you could invest in private equity, which would be 10-year lockup, and they'll go out and buy physical assets or mines in weird parts of the world. Or you could trade futures, but their rules were such that you needed $10 million of cash on deposit in your bank account to trade a futures contract. And so this huge vacuum existed where retail investors, if you will, could not get exposure to what I think is the biggest macroeconomic theme of the next 10 or 20 years of our lives. And so I said to John Raymond that week, we need to build an ETF for this thesis. And here we are years later, and we've brought it to market under the ticker CHARGE on the New York Stock Exchange. And we're very, very proud of it.
And the ETF's name is EV Solar and Battery Metals Futures Strategy ETF. Yeah,
the name, our ticker is CHARGE, and the name of our company is the Energy and Mineral Group Advisors. And the name of our fund underneath the line CHARGE is quite long, but it's quite descriptive. And what we really aspire to do is look at all of the different demands for these metals. You know, as I referenced before, when you have an oil and gas energy source, you turn on the motor, it burns the gas, it creates energy. When you're acquiring solar, sun, wind as your source, those are intermittent supplies which require a battery to harvest and harness the energy when it's being created so that it's on demand when it's needed for use. And so all of these future green technologies require battery technologies, and all battery technologies currently require lithium, nickel, and cobalt in varying degrees, but also the connectivity to all of those batteries, be it in charging stations, in wiring from the battery to all of the power points. All of that interconnectivity requires copper. Every EV requires over 1 mile of copper wire. And so the demands for the copper markets are massive. And we don't think that the markets have fully comprehended that yet. And that's why we put the product into the market.
But unlike a physical precious metals fund that owns gold or silver in a vault in Switzerland or something, your fund uses futures contracts. So could you explain that to me, how that works as if I were 5?
Oh, man. Well, that would be a 4-year-old explaining to a 5-year-old. It's a quite complicated market. I will say that trading futures, albeit complicated, is far less complicated than trading physical. And the obstacle to trading physical is exactly as you reference. You need a physical facility. Not only do you need a physical facility that can take it, an infrastructure that can bring it in and take it out of there, but the way that the markets work, as evinced by this interesting Trafigura nickel story in the last week, are that those shipments need to be in regulated supply chain. And so where the trusted facilities are either the LME, Shanghai. There are finite locations that can store this stuff. Oh, by the way, these assets are in such demand that they're not sitting in storage. They are in motion. They are being consumed as quick as they can be produced. And so the trading of physical is harder and harder, and also brings with it significant costs and risks. The futures market is rising. Since September, the depth of the lithium futures market has 20x'd. And so, people are more and more using these futures markets. If you're a miner, you're able to sell the future price activity of the asset you own in the ground to pay for your current operations. And so there's a lot of activity there. If you're an EV company, I think you'll see more and more. Those folks should be buying probably our product because they will be locking in today's price as an entry point for their ability to acquire those assets in their future. But there's a big vacuum in between that I really think we've filled by leveraging these futures contracts. And I'll also give a nod to our lead portfolio trader, Ryan Doffelmeyer, who for 7 years ran commodities trading at ProShares. And for almost a decade before that, ran volatility trading. So there's nobody better equipped to trade in the futures markets, we think, than he. And we're very proud to have him at the helm of that operation.
But let's talk about the risks inherent in your strategy. Investors who want exposure to the prices of the underlying metals have 2 levels of potential distortion, as I understand it, because first, the price of the futures contracts that you're holding can get out of whack with the price of the underlying commodity. And then second, the price that the investors pay for shares in your ETF floats based on market conditions and can equally get out of sync with the actual net asset value of your fund. So to what extent do these types of distortions happen?
Yeah, so let's use the term slippage, which is a common term used in trading. Like, what is the friction cost, if you will, of this medium? And then let's also talk about what are the options, right? We believe that we will be within 1% of that price activity. So it's our job to keep the pricing within 1% total of any cost price increases or decreases. And that's a great value, I think, if you're able to accomplish that. And so you really need to look at what's the other alternative, right? So if I'm not trading futures, if I'm not doing it through the charge ETF, what are my options? My options are buying equities traded on stock exchanges of miners, many of whom, as you know, are startups at this point. You know, they're not people with long track records of having done this. You're able to trade some of those in the United States, but the most of those trade in China. And so you have to introduce, exposure there and assess your own level of trust in the numbers that come out of that part of the world. And so I think personally that the most effective and efficient way to trade these markets is with the futures contracts, even with a potential slippage of sub 1%. And so you have to trust our ability to deliver that. And you also have to look at, would you rather 99 point something percent price participation in these underlying markets, or would you rather exposure to the Panamanian government or the execution capacities of countries and of companies in the middle of Africa? We think that the risks that are borne by any other ETFs or by the direct equities that you're able to trade are way higher because you're exposed to execution risk. Look no further than Tesla. Lithium being up 180% last year, EV adoption being up multiples, and Tesla being down 70% in the calendar year. It makes so sense because all of the macroeconomic factors point to amazing growth for Tesla, amazing adoption, amazing success. But you were exposed to Shanghai shutdowns with COVID. You were exposed to Twitter distractions. You were exposed to Elon dumping $26 billion worth of stock. And so you, as a Tesla shareholder, were right in your thesis. EV adoption is on a tear, but you had the wrong security in your portfolio. And so you wake up at Christmas 2022 and think, oh man, I can't believe, two of my uncles have Teslas at New Year's Eve dinner. My bet was right. Look at all this adoption and look at all these U.S. Postal Service is converting to EV, and the Inflation Reduction Act has all these benefits to buying EV, and I nailed it. And then you look at your stock portfolio and you're down 70%. You're not too happy. Whereas if you had just traded the base metals that go into making a Tesla and stripped out the risk of being exposed to Elon's hijinks, or Panamanian governments or Peruvian or Chilean governments that just come in and say on a whim, you're not operating tomorrow. Those are way higher risks than just pure exposure to the underlying price activity, which we think should be, massive in these coming years.
And how many pounds of each of the underlying metals do you own through these forward contracts? Or in other words, how do you decide the breakdown between the metals in your strategy?
I don't want to give you the wrong information on that, but I'll give you some round numbers. The way that we will work is picture a futures contract associated with copper versus lithium versus nickel versus cobalt. Those have different prices per contract and different weightings associated with each contract. The way that the underlying function of our fund works is as we increase, every $600,000 or so of AUM that we increase, we go out into the market and acquire a mixture of contracts that keeps the percentage that our investors are exposed to the markets in line with what our goal and our target weightings are. Our current target weightings based on the kilograms per asset necessary to build a battery are 52% copper, 27% lithium, 17% nickel, and the remainder in cobalt. And it's our goal and aspiration to deliver those exposures to our investors, because our data shows that if you were to spend $1 building a battery, that would be where that dollar would go to. And therefore, that is the most exact exposure to every incremental demand for battery, which again, if you're trading Ford Motor Company, who less than 5% of their total vehicles are EV, or you're trading Tesla, who has the distractions that Tesla has, you're exposed to their ability to deliver cars, people wanting those cars, all these extraneous factors. When you trade our metals and our percentages, you are weighted perfectly to the kilograms in demand per battery, regardless of who consumes it. Solar, wind, Tesla, Ford. We don't discriminate. We give it to you across the board, because the West is yet to be won, as they say. We don't know that Ford's going to be the winner in this deal. We don't know that Tesla's going to be around in 10 years, or if Tesla's going to be buying Ford, but we're not making a bet on that, because that's not what our expertise is. Our expertise is telling us that no matter what of those companies win, we win.
Mm-hmm. Could you outline then the primary uses in the green energy revolution of those four metals that your ETF tracks, namely lithium, nickel, copper, and cobalt?
So to take copper, let's just address copper off the bat, because we think copper is wildly underpriced and have a majority of our portfolio in copper today. No matter which of the batteries connect to no matter what use, copper is required, right? There are different battery technologies, and I'll talk about those in a minute. But regardless of the battery utilized, regardless of the source from which the energy comes, wind, solar, sea waves, braking on your car, any of those sources that create energy, that connectivity needs to go into a battery to harness the energy, and then it needs to come back out of that battery into the destination that's going to be using that energy. All of that connectivity is copper, right? So if you see, we're going to put EV charging stations in every gas station, cool. You know what that does to copper demand? Massive, massive demands for copper. So that's what it is. Let's just put that aside. Now let's talk about battery technologies. And as I said about car companies, the West is yet to be won. There's tremendous budgets. Over $750 billion have been committed by the top 10 car manufacturers across the globe towards R&D for battery technologies. There are different use cases. If you're driving a U.S. Postal Service truck, 100 miles total a day on the same route, never going over 30 miles an hour, always going back to a charging station at 5:01 p.m. or maybe 4:59 p.m., given the way most government employees work, that requires a different battery, right? That requires only a battery with short range that doesn't need to have on-demand speed. It also brakes a lot and stops a lot, which allows energy to be recaptured through that process. Now, separately, let's say, I live outside Washington, D.C., and I want to drive to New York in my fancy Tesla. I need to go 400 miles on one charge. I want to go 0 to 60 in 2 seconds. I want to have all the accoutrements, right? That's a completely different battery, right? And so the battery in a Tesla is currently what they call an NCM 811, which is 8 parts nickel, 1 part cobalt, 1 part manganese, for lack of a more scientific explanation. But then you see like the Ford Lightning is requiring a different battery, and it's different weightings of nickel and lithium. There's new battery technology called LFP, which doesn't actually have as much nickel in it. And these are all things that we track. So what we do is we go out and we look at all those different demands for all those different use cases and say, look, Ford says they're going to make 3 million EVs, and they use this type of battery that requires this volume by kilogram of nickel. Well, then we plug that into our kind of quantitative models to show what we think that leads to for global demand, per annum of the underlying assets. And then when you pair that with the sources from which we're getting this stuff, the miners, that whole supply chain, you're able to get excited about, what should happen as demand rises and as supply fluctuates.
So cobalt and lithium obviously important in lithium-ion batteries, which over the last couple of decades have come to dominate the rechargeable battery space and are now used widely in laptops, mobile phones, cameras, and other portable electronics. But do you worry about the possibility of batteries that don't use these metals gaining market share? For example, there have been developments with sodium-based batteries that replace lithium. And there are also liquid metal batteries being trialed that use antimony and a calcium alloy anode. So is there a danger in your mind of the metals that you've chosen getting left out by future technological changes in the battery space?
Well, that's the beauty of the way we've structured our business. We're actually an actively managed fund, which is very different than anything else that you'll see in the market. It's shocking to me as an investor that a lot of these ETFs are quote unquote passively managed and just track a passive index. This is not a sector you want to set and forget in allocation. I would not be excited to invest in our portfolio if it was going to have the same weightings 5 years from now than it does today. It does not. We actually have really daily conversations, but at the minimum on a monthly kind of cadence, our investment committee meets and reviews all industry news, all industry inputs, and adjusts our portfolio appropriately. The reason why our portfolios today have less lithium than they would have last year is just because of the price run up in lithium. And we think that that's a bit high right now. It could continue. I think 5 years from now, it will be multiples of where it is today. But 5 days from now, I have less insight. I'll also point out that we have a sub 5% exposure to cobalt because of what you are stating. Because cobalt, or the vast majority of it, comes from the not so democratic Republic of Congo, we don't have great dependence on that. And I think that the markets have driven technologies that even might not be as efficient as they could be, but are taking out our global demand and need to depend on that Central African country for those battery technologies. So I think you'll see that play a role as well. And as those chemical compositions mature, which all of that $750 billion I referenced before of R&D is going towards, is figuring out what will be the best battery that we all use. As that continues to be figured out, our portfolio matures and adjusts with that so that you aren't stuck exposed to something that's archaic. You're going to move with these markets, and we anticipate these markets are going to move.
So you're open-minded to adding in new metals that might become relevant?
Our docs allow us to, and on a monthly basis, we assess whether or not to do that. There are real demands for graphite and manganese, as an example, in our current weightings, but we don't see the supply chain being as volatile in those assets as with the others. So we've chosen not to have an allocation of that just because we don't predict crazy price activity there as much as we do in the other base metals. But all of that, that's what I think is really unique about us, is the Energy Mineral Group has deployed over $25 billion over the past 17 years in energy and metals and minerals investing. And so this is who you have at the helm making those decisions and giving you those allocations in a product that trades daily on the New York Stock Exchange. So you have perfect 24/7 liquidity, or as liquid as the markets allow. But you have, best-in-class private equity brains setting your portfolio, which you otherwise would have to lock up money for 10 years and have some massive minimum investment amount to get. This product, you can buy as little of it as $25 or whatever our stock price is today. And, that gives you full exposure to this rising tide, which we think is really exciting and interesting and what the market deserves.
What do you think of the prospects of a cartel in lithium production forming, given the large amount of the world's supply that comes from the South American lithium triangle, Bolivia, Argentina, and Chile? There's been some talk of an OLEC forming, the Organization of Lithium Exporting Countries, like OPEC. Does this fit into your outlook and narrative around investing in lithium?
Yeah, some of that will be healthy. Some of that will lead to less transparency in how the pricing is affected. What OPEC has ended up being is a collaboration of those that control the supply, deciding what they want the pricing to be. And that's not necessarily always healthy. However, I will say anything, even in that triangle or elsewhere, that collaborates and brings us more secure sources away from the Chinese government making that decision unilaterally, I think is healthy for the global markets. And so I welcome that. I think that's healthy and positive, and will only strengthen, sources outside of China that, albeit they volatile governments and regimes, they are way easier to engage with than, a superpower like China unilaterally deciding that, they don't want us to have what they got, or that they want to self-consume their own supplies and just sucking that out of the market, which would drive pricing parabolic.
I can imagine that with the kind of left-wing governments that are so normal, especially nowadays in Latin America, that countries like Bolivia and Argentina and even Chile might want to democratize or nationalize the sort of control of their lithium production. Although I guess because Australia is a major producer as well, that would somewhat reduce the threat to global supply.
Well, this OLEC conversation doesn't need to be geographic. And so it could be a collaboration amongst many parties that do have lithium reserves that choose to act in concert. And I think that that's fine and welcome. And it's a good opportunity for the market to have a little bit more stability. Also, if any one of those countries wanted to push back on the Chinese government and their activities, they would have a harder time than if they were aligned with every other source of that material. At the end of the day, for us, the demand story is clear, right? Nobody says, oh, there won't be more batteries tomorrow than there are today in our world. I've yet to meet anyone that could tell me that. And so if you believe in rising demand, even if supply was secure, this would be a great opportunity, a great investment. But because of everything that you're adding on top of it, and because of how we're defining the governments from which these assets come, that supply being volatile is even more exciting about what price activity could do at any given moment. And I think that that's something that we really have to track closely. But an investment opportunity that has rising demand and fixed supply is something that I want to pour into. Introducing all this volatility on the supply chain as well, it makes this just exponentially more exciting. And so any of that volatility is actually good for our price activity. Now, if I may differently point out, if you're a miner, that is the opposite of what I just said is true, right? If you're a mining company who are dependent on non-democratic countries for allowing you to operate, that volatility could be terminal to your business. And so some of these other funds that are invested in a handful of miners, there's a lot of risk there that you just don't need to take, and that we've chosen not to take, right? Now, I'm not talking about the Albemarles and the SQMs of the world that are multinational and diversified. The largesse of these assets are coming from, places that don't have sound democracies per se, and that we have great relationships with in perpetuity. And that's, going to be a problem. And so that's a risk for the miners. But, any miner that goes offline, any country that goes offline or has volatility just sucks supply out in rising demand. That just means pricing goes up faster. And so that's good for us and bad for the miners. Now, I'll just point out one more derivation of that. I think it's important to look at both source of physical and also manufacturing, because even though there are physical metals in many parts of our world, when you then look at where that stuff has to get shipped to be manufactured into a battery, that is also 70+% Chinese. And so even if you're finding this stuff, in Chile or if you found it in Nashville, Tennessee. We need to have better and more diversified places for it to be manufactured, or else, we're at the same bottleneck regardless of where it's created.
Lithium carbonate prices had a really impressive bull run in 2021 and 2022, running up by around 300%. But since November last year, they've dropped considerably by around 20%. Do you think that if you weren't invested in lithium 2 years ago, you're probably too late to the party?
Not even close.
Could you speak then to what has driven prices down in the last few months?
Well, to your first question, we're not even in the first inning of this game. If you just look at government carbon neutral targets of the amount of EVs that will need to be on the road to replace combustion engines, we literally are less than 1% of this story has happened. And so we are far from even being called early. That lithium activity over the past 2 years, and then differently in the last 2 months, is just pure supply demand. Again, that's good for us in the long term, because what happens with these markets is you don't just turn on the spigot and have, we're not pricing seawater here. If I found lithium under my basement today, it wouldn't be in the market for 8 to 12 years. And so these supplies are very, ebbing and flowing based on mines coming online, production coming online. And then when you pair that with how they're being consumed, and if the car companies are going directly and just acquiring these assets themselves, that's all sucking supply out of the market, and demand is not going down. And so we think that it's not even 1% of the story has been told, and we're very excited to be in the market as early as we are.
Goldman Sachs, on the other hand, are forecasting that lithium carbonate's price will fall to $53,000 a ton this year before cratering to $11,000 a ton in 2024, because they think that supply is going to basically outstrip demand. Your forecasts are different, I'm imagining?
No, we take that into account. We all are looking at the same data at the end of the day. What I think is hard to assess is the speed of adoption. And so, Goldman Sachs and banks that don't live and breathe the space can easily look at math equations and can easily make decisions on how much supply is going to come into the market in the next 18 months, at what pace, at what cadence. That's all well and good until the Peruvian government says, you know what, you're not working today. Or the Panamanian government says, you got to give me 20 cents of every dollar just because I say so. That's not contemplated in the math. And so I think, these markets have traditionally had people that are good at math putting together projections. We have people that have dirt on their boots, that actually live and breathe this stuff. And we don't disagree that there will be ebbs and flows of oversupply and undersupply of these markets. But what I can assure you is over the course of the next 10 years, 5 years, 3 years, the demands for these metals far outpace the supply that we have. And even if tomorrow, like I say, we found the Grand Canyon ended up being full of lithium, 8 to 12 years from now, that will be in batteries. And so what are we going to do for the next 8 years? And there's a massive lag to those supplies actually making it to market.
Let's turn to copper. Copper was in the doldrums during the summer of last year, but it's been on a bull run since October, with the COMEX copper price showing a 60-day rise from $3.60 to $4.20 per ton. However, in the last couple of weeks, it's been softening again, despite China's reopening and civil unrest in Peru choking supply from Las Bambas mine, which supplies around 2% of the global copper supply. So what's going on with copper, and where do you see it ending 2023?
We see it ending higher, significantly. What's going on, these markets are also tricky in that you have to recalibrate your time horizon. I think it's just the nature of our world with Twitter and, CNBC on 24 hours a day and Bloomberg and, news alerts. And we all live in an environment where data is ever present and is constant, and it's constantly being alerted on our phone. This just happened. This just happened. These markets trade at more of a lag to that than people, I think, understand. And so because they're not traded as liquid as Apple shares, if Apple has a problem and announces, bad news, their stock moves immediately. Whereas there's way more of a lag to how, the copper market, as a good example, does trade. And there's far more factors in it than just the news cycle, because I think of what I'm talking about how long it takes for supply to make it to market, that, that Panama mine went offline. Sure. Well, we hadn't contemplated supply hitting the market from that mine for another 18 months. So it actually isn't going to impact the price today, but it will impact the price 18 months from now, when the market was predicting that supply would hit the market and it doesn't come. That's when you start to feel that true pain. So these markets do trade at more of a lag. And that's why, we are forced, even though we trade liquid on the New York Stock Exchange all day, every day, we have to zoom out a little bit and assure our investors, we're going to be in good shape here in the future. Don't worry about the next 5 minutes. When people say to me, what was the price today? It's almost like, it's unhealthy to watch like that. You're just going to find a good entry price and be happy that you're in as early as you are, as opposed to saying, oh man, we really had a bad day today. You got to zoom out.
Mm. Famously, copper has earned the nickname Dr. Copper because it's a leading indicator for the overall economy. And during the 07-08 financial crisis, copper went into free fall from a high of $3.82 to a low of 1.4 per pound. Are you expecting a global recession? And if it hits, what would that do to copper? Could it just halve or even worse?
What's been interesting about the last, and I quite was at the front lines, if you will, of the 07-08 stuff, because I was investing in the debt markets, which was the front lines of that activity, and learned a lot because of it. I don't believe that we're going to have a recession like that. I think there's some believe that we're in a recession, and because of the way that the governments have reacted to the COVID dilemma and printing money, and we could go down that rabbit hole for a long time, which I'd be happy to do, because it's a frustrating thing to watch from the sidelines. But at the end of the day, who that affects is more broad than those that are engaging with the EV market, as an example. And so, the EV market has actually been decoupled from, the global kind of GDP volatility that we've seen in COVID, just because its current pricing only avails itself of a more high income person who's less affected by Fed activity and less affected by job claims and less affected, by the real impacts to our economy, which will have really negative long-term impacts to all of us. But I think, the person that's going and buying a Tesla for $80,000 to $100,000 has been far less impacted by this current duress or potential, recession. And so that's why I think you've seen, a lot of this, Joe Biden came out with this Inflation Reduction Act, which is the most poorly named bill in the history of mankind, because all it did was address pushing out more stimulus into the market, which is only going to create more inflation. But I'm not his PR department, as much as just assessing the fact that, there are massive volumes of stimulus that have been pushed out to incentivize EV production, incentivize EV purchases, incentivize solar and wind adoption. And so governments are using their tools to push, adoption which is why I think you're seeing that decoupling that I reference, is because, if it were to have cost you 8 cents to build a battery before, and the government comes out and says, we're going to give you 2 cents of tax breaks. Well, now all of a sudden it only cost you 6, and you can sell it for 7 and still make money. So even though, the markets are feeling pain, the companies are still able to keep their margins where they need them to be. And that's why you're seeing a lot more shovels going into the ground and a lot more activity, even onshore in the United States, which should not be paired. We don't think we'll be, as exposed to, potential duress as other consumer goods.
Commodities have had a great start to 2023, and the weakening of the dollar has been a significant tailwind there. Do you think that trend is likely to continue throughout the rest of 2023, or do you think there could be once again a flight back to the relative safety of dollars, which would push up its value relative to other currencies and sort of be a headwind to commodities once again, as it was last year?
Yeah, I think our market is redefining stores of value, and also reassessing global demand for gold, and what is gold actually tangibly used for. So when I think of flight to quality away from US dollar, I'm certainly not seeking exposure to other currencies than the US dollar, but they have pushed a lot of supply into the market of US dollars, and that will, bring complications here for a while. They cannot push supply of lithium into the market. The government cannot affect that negative, curve of base metals. And so while you see the Fed and, global treasuries manipulate markets by controlling debt and controlling access to capital and controlling total supply as a real ratio to total demand, they can't do that with physical metals required for this green expansion that they all want to see. And so you will see them actively manipulating the US dollar, and you will see them actively manipulating FX rates globally. It's very hard for them to actively manipulate supplies of these base metals. They have manipulated demand. They have created new demand by pushing incentives out. And so that's interesting, but they can't manipulate supply without bringing in taxes or, things that would run directly in contest to what they've stated their global policies to be, which is to push for green expansion and adoption. So this isn't about U.S. Democrats versus Republicans. This is a bipartisan push to expand the sources from which we get energy, so that we're not dependent on Russia and Saudi Arabia till the end of time, and them pivoting away from creating incentives for broadening the supply from which we get energy would be shocking to 100% of the people that I talk to.
Moving on to nickel. Last year, after the Russian invasion of Ukraine, nickel became the subject of a short squeeze of GameStop, meme stock, Wall Street bets proportions. And its price went from 20,000 a ton to 100,000 a ton, based on covering a massive short position. What's been happening in the nickel market since, and has there been any long-lasting impact of that episode?
Yeah, I think all of the metals, but nickel specifically. First of all, nickel is very important to the recyclability of batteries, so I think that there will always be a push for prominence of nickel, and that's been an interesting kind of chemical composition to track. But as I said earlier about the lag, some of that short squeeze stuff happens when people react abruptly to an invasion, because then they say, well, wait a minute, what's going to happen here? We're going to put sanctions on Russia, which is going to limit their ability to sell us nickel, which they and that part of the world are a big producer of. So that's going to take supply out of the market. And now all of a sudden, all of those that were short nickel are saying, well, I don't want to hold this bet anymore. I got to get out of this trade, because that the supply just changed massively. So they want to get out of that, which means they get out of their short, which means prices rip, all those things trickle through. And so those outlier events will continue to happen for sure. And it's important to weigh, again, what are the sources of these goods, right? If we're dependent on China and Russia and Peru and Chile and Panama for these metals and for our green future, yeah, I'm nervous about that. But on any of those nerves lead to price appreciation, because if it stays constant, we have rising demand. If it gets disrupted, we have rising demand and shortened supply, and that's when things get interesting.
On the topic of nickel, I think it's another metal that I would be a bit cautious about having exposure to in the event of a global recession or slowdown, because only around 10% of nickel demand comes from batteries, and the vast majority is for its use as an alloy in making stainless steel. And of course, steel is very sensitive to interest rates and to the state of the economy in general, because it's used in housing, infrastructure, capital goods. Do you worry about the effect of a slowdown on nickel prices?
Yeah, a global slowdown is not good for anything. But what I think we need to zoom out and look at is, if there is a slowdown in the demand for nickel, for stainless steel, that needs to be priced into the market. But what people underappreciate is that these markets have been around for a long time. This is not a new asset, right? So if you look over the last 10 years, what were the demands for nickel? EV is not on that list. So when you add solar, wind, battery technology, electric vehicles, that is all new demand for nickel. So yes, housing starts being down is not good for stainless steel numbers, and that might suck some of those numbers out of the market. But you have this new participant in the market that you haven't had for the last decade that is bringing brand new demand to the global static supply of nickel, that, it's hard to assess what that's really going to trickle through to be. So yes, there might be less demand for nickel in stainless steel use cases, but there's a lot of new demand for nickel in EV and solar and wind that didn't exist in the market until quite recently. And how's that going to offset some of those concerns? And so I'm not sitting here saying that all these assets only go up. I'm saying that over a period of time, we're very excited about where they should go.
As well, there's a lot of speculation last year because Norilsk nickel in Russia is a massive supplier of the metal. But so far, they've escaped sanctions because the magnate Vladimir Potanin, who is on the sanctions list, controls less than 50% of the mining giant. And what's more, Norilsk nickel actually increased its output by 23% year on year in 2022. So while speculators were imagining that this supply was going to get cut off because of sanctions, in fact, it remained and even grew during 2022. But do you think that in the future sanctions might apply to Norilsk nickel, or do you think that a slowdown in the Russian economy or difficulties in obtaining parts needed to keep their factories and equipment going could lead to a reduction in the amount of nickel that they're able to actually produce and put on the global market?
Certainly so. But what I'll draw your attention to is the route nickel goes from Russia to the batteries that we consume. It doesn't come, the majority of that comes through China. And so so long as I don't predict sanctions between China and Russia, that flow will continue. And that asset will flow from Russia into China, and they couldn't be closer than they are today. Far more of a risk, hypothetically, is to the supply from China post-manufacturing being impacted to the rest of the world. And I don't believe our risk is as high at that as I do believe that the high risk is the Chinese government saying, you know what, we need this stuff for ourselves. So why am I exporting this to the United States for the same cost that I can self-consume it for? You know what? I want our batteries to be the best. I want our EVs to be the most prominent. I want our factories to be the most efficient. And then they say, unless you sell as much as the Chinese economy will take, you can't export this good. That's a way higher risk to me than us saying to China, we're not taking your nickel, because we need their nickel, right? And that's really what's kind of keeping this frenemy relationship between our governments, is because we need it. My risk is assessing China, deciding that they don't want us to have it. What's that do to the price of nickel? If all of a sudden any nickel manufactured in China, whether or not it came from Russia or where it came from, manufactured in China and put on a boat or a train for a foreign country, if that ends, I don't even want to predict what that would do to the price of nickel.
Let's finish by touching on cobalt. What should we know about the supply and demand picture for cobalt?
As someone who spent a bit of time in Africa and haven't been to the DRC, but I've been to Rwanda and know a lot about the history there. I was lucky to be not lucky to be, but lucky as a global citizen to be at the 20th anniversary of the genocide that occurred between the DRC and Rwanda, which is just a horrible story and something that anybody that isn't aware of it should study. And I made the joke before that I refer to them as the not so democratic Republic of Congo. That is, I think, 88% of the global supply of cobalt comes from the DRC. It's a landlocked Central African state. It's a dictatorship. It's an enemy of all of its neighbors. It is a well-known child labor location. You don't want to know how bad it is there, and that's why I think you're seeing the technology get away from cobalt, because we cannot have, it's so ironic to me, all these ESG goals. Oh, we want to have ESG. Okay, go look under the hood and figure out where that cobalt came from that you're depending on for your ESG future. You ain't going to like what you find. And so I don't view cobalt as something that will be prominent 5 to 10 years from now, because I think that a lot of the R&D and a lot of the global movement is going towards chemical compositions that are utilizing more diversified and secure supplies.
Okay. It's been a fascinating conversation. Thank you very much for taking the time. Is there anything that I didn't bring up that you'd like to mention before we finish?
No, I appreciate the work you guys do. I really value it as a source. I think you do a great job covering the sector. I think it's really important for us all to stay in tune with the sector, but then also zoom out when it relates to the investment opportunity in the sector. The audience can't trade futures. Sorry. The governments and the SEC haven't allowed for just options trading in futures contracts of these things. And so we're proud to bring this product to market as what we think is the most efficient way for retail investors to participate in this. And so while it's important to track this data on a day-to-day, minute-to-minute basis, I always encourage investors to zoom out and tell me where they think it'll be in a year or 2 years or 5 years. And if you take that view, like I say, I think we're so early in the story that this is the biggest macroeconomic opportunity of the next decade of our lives. And we're excited through our Charge ticker to provide that exposure really effectively and efficiently. And appreciate everyone tracking what you all do, and we are more and more trying to be a source of smart information from emgadvisors.com and from our Twitter and LinkedIn, because we live and breathe this stuff and try to just push out the stuff that we find interesting to the market. We're undefeated in finding articles and news items and data points that support our thesis. So we just got to keep learning.
Fantastic. Thanks again for taking the time. We hope to have you back again.
Thank you so much.